Hold up, wait a minute. Hold on. Okay. But I said I can't bitch about the bill. Reason why I can't bitch about the bill, because he didn't bitch about the bill. So I said, you know what? I started talking to myself. I said, Kev, just pay the bill. Pay it. So that's what I did. I paid the bill. I go to my room. I go to sleep.
What's going on, guys? It's Minh with What's a Mortgage. Today we are going to talk about the mortgage bills. We're going to go over closing costs today. If it's your first time tuning into What's a Mortgage, welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. Tonight, guys, we're going to talk about that bill, right? That bill that everyone sits there and waits, and they want to see the bill, but they don't understand the bill. And tonight we're going to break down that bill. So if tonight you have questions regarding the mortgage bill, closing costs, definitely ask. All right. Also, if I bring you any value tonight, do me a huge favor. Hit the like and the save button. All right. The save button helps out. What I learned, if you save a video, it helps the algorithm even more. All right, guys. So, guys, hopefully you. Oh, and subscribe. Forgot. Andy just told me subscribe. Don't forget to subscribe. Caught me off guard because I'm doing this video thing today, right? Guys, how you guys doing tonight? Hopefully you're having a great night. A lot of you guys, if you guys are already following me on Facebook, definitely check out our YouTube channel, right? Also, on our Instagram, in the next couple weeks, we are going to be putting exclusive content on there regarding mortgages, right? Little tricks that you haven't seen anywhere else. They're going to be on our Instagram page. So please follow us on Instagram, all right? I think we're going to start posting it maybe April, right? There's certain content that will be only on Instagram because it's easier to put it in the stories. All right, guys, so don't forget to check that out. So let's get into it, guys. Tonight, we're going to talk about closing costs, right? When you buy the house, what are closing costs, right? It's already hard enough to save the down payment. Now you got to save closing costs. But I hear this happen all the time. Man, what am I paying for? Right? Like in that video, right? You get the bill, you stare at it, you got to pay it, but don't you want to know what you're paying for? Right? So tonight we're going to break down the 5 categories of closing costs. We're going to break down the categories so you understand these closing cost fees so you know what you're paying for when you're purchasing a house. All right? So I know the fees, you'll see a bunch of lines when you get your loan estimate, but all the fees are pretty much in one of these 5 main categories. I want to break that down and give you a little secret on how to figure out closing costs. All right. So let's get into the first fee of closing costs. Title fees, right? Title insurance. When you're buying a home, there's 2 types of title insurance. There is the borrower's policy, and then there's the lender's policy. They call it owner's policy and lender's policy. Typically, the seller will pay for the owner's policy, which is your policy. If you're buying a house, the seller pays for the owner's policy. Sometimes when you get a loan estimate, you'll see the word owner's policy and it says the word optional, which means that is a charge, but doesn't mean they're going to charge it to you. Typically, when you're buying a house in the purchase contract, it will say the seller is paying the owner's policy, which is very industry standard. But sometimes it does happen where the seller doesn't pay, especially in a seller's market, right? That's why you want your own representation as a buyer. The last thing you want to do is go with the agent that represents the seller already. If they represent the seller, they got to protect the seller. So sometimes, right, they will ask the buyer to pay for title insurance. But typically, the seller pays for the owner, which is you, the buyer's title policy. The policy that you buy that is on your loan estimate is the lender's policy. Unless you're paying cash for your property, if you are financing it, you will get lender's title insurance. It lets the lenders know when you are getting a loan on the house, there's no other liens on the property. It's not a cloud lien. So when you pay for that insurance, it's guaranteeing the lender that there's no other liens on the property when you're buying it, right? Same thing when the seller pays for your policy, it's guaranteed when the home transfers to you at that moment, there's no liens on the property. Doesn't mean liens can't pop up later on, but the moment they give it to you, no other lien is on the property when you buy the home. So that is title insurance. Title insurance is based on your purchase price. Depending on the purchase price, right, they issue your title insurance. All right. So once you get your title insurance, the second fee is escrow fees. Okay. When you're buying a home, escrow fees is based on loan amount. All right. So depending on the loan amount, it's either going to be $2 or $2.50 per thousand. There's a seller side and there's a buyer side. When you are buying a home, everyone has their own responsibility for escrow. But this is where some escrow companies, not all, they get tricky. It happened to one of my borrowers where the selling agent picks escrow. Typically, when you're buying a house, the selling agent, not even the seller, picks title and escrow. Not all, but a lot of times, the selling agent, right, they've worked out deals with some escrow companies where they keep the fees low for escrow. The reason why is when the selling agent presents their listing agreement to the seller, their fees look a lot lower. But how they balance it out, sometimes they put it on the buyer side, which is a no, right? Doesn't happen as much as it did back then, but it still happens. That's why you want to make sure you have a solid loan officer, a solid buyer's agent that protects you, that might look at the fees like, hey, these fees are a little high. So we did have a borrower last year. Thank goodness his sister worked for another escrow company. But of course, he can't use his sister because he's the buyer. The selling agent picked an escrow company, and the escrow fees were about $1,000 higher than normal, right? They caught that, and they went back to the seller, and they got the seller, the escrow, to back off on the fees, or they were going to close escrow, right? They really want to open Pandora's box. So when you're buying a house and you have escrow fees, make sure you check with your lender. Hey, are these fees high? Can you check for me, right? The last thing you want to do is overpay. You already have other fees you're paying for. The last thing you want to do is get overcharged for fees that belong to the seller. Okay, so when you're buying a house, there's escrow fees for the seller and for the buyer. Just make sure you're not overpaying your fees, right? Remember, per every $1,000, it's $2 or $2.50. And remember, there's also flat fees that are attached between $200 to $500, okay? And little other junk fees between $700 to $800. So be careful of that, right? You want to pay attention to those fees because those fees can all add up. The third fees, right? The third fees that when you're purchasing a home are your miscellaneous fees, right? These fees a lot of time are non-negotiable. They're third-party fees, right? Appraisal, home warranty, flood cert, notary, wiring. It's not wiring that belongs to title, recording. It's a county fee, right? Home inspection, that is optional. Credit report. Some lenders charge for credit report, some of them don't. Most of them do now, right? Termite inspection, endorsement, sub escrow, HOA questionnaire. If you're buying a home that has an HOA, there's an HOA questionnaire. Also, if you're buying an FHA loan, you're using an FHA loan or a VA loan to purchase a home. When you look on page 2, section B, that's where the lender's miscellaneous fees are. You might see an upfront funding fee, or upfront MIP, or the funding fee, right? Typically, when you're buying a home with an FHA loan or a VA loan, those fees are financed, right? You can either pay for it upfront, which not a lot of people do. They typically finance the upfront MIP and the funding fee. You'll see the charge on page 2 in section B, but you'll also see a credit at the bottom of page 2 as well, right? They'll charge you, let's say they charge you $4,000 for upfront MI or funding fee, but you'll see a $4,000 credit added onto your loan amount to increase your loan amount to cover that fee. All right. So that right there are the 3 main fees that I think a lot of people go out and you're purchasing a home. Those are non-negotiable, right? But you should know about these fees. Typically, when you go out there and buy and everyone's throwing all these fees at you, they can get confusing. But just know when a lender presents these fees to you, they don't control them. Some lenders, right? I just have one happen recently. They downplay the fees, right? So they downplay the fees, but in the day, they don't control those fees. So all they're going to do is go back to you and go, by the way, I don't control those fees. But it made their fees look a lot lower, but typically their fees wasn't as low. So be careful that when you're out there comparing fees, you don't compare title. There's nothing really going to be wrong with title. You don't compare escrow because at the end of the day, until escrow opens, we don't know. And you don't control miscellaneous. Most of those fees are set. Doesn't matter which lender you use, right? The MIP or the funding fee is going to be the same. Credit report might be $40 with one company, maybe $50 with another company, but they're all around the same price. Appraisal, it's either going to be $500 or $600, right? So remember these things when you're out there shopping. Don't focus on the fees that all the lenders cannot control. No matter which lender you use, they aren't going to change those fees, all right? So remember that when you're out there shopping. And here are the fourth fee. It's not a fee, it's actually your cost, but some lenders do the fees differently, but it's called your prepaids, right? Your impounds. So typically when you have impounds, you have your hazard insurance, you have your property taxes, and you have your daily interest, right? So when you're buying a house, depending on who you pick For hazard insurance, we don't know. But typically, if you haven't decided the hazard insurance yet, it's about 0.15 of the purchase price, not loan balance, purchase price, right? There's a little error right here. It's the purchase price. Take the purchase price, times it by 0.15, right? Divided by 12. And then whatever it is, times it by 14. Because typically they'll collect 1 year and 2 months, right? So they'll take 1 year and 2 months of your hazard insurance, right? The 1 year you pay up front, and then the 2 months they collect for impounds. Property taxes, purchase price times 1.25. If you don't know what the tax rate is, divided by 12. And then depending on when when taxes are due, right? Your impound schedule. We'll go over that in just a second. But typically, your impounds are dependent on when you're going to close, right? If you close in October, November, it'll be a lot more it'll be a lot pricier than closing in February, March, and we'll show you in a second. And then your daily interest, right? So if you fund the loan on the 1st, there's 29 days of interest. If you fund the loan on the 30th, there's only 1 day of interest, right? So depending on when you fund, it's kind of like paying rent prorated, okay? So when you have impound, there's hazard insurance, 1 year and 2 months, right? Property taxes, depending on when you're going to fund, and then daily interest, it's the interest rate you're going to get, times it by the loan amount, divided by 365, and times it by the amount of days left in the month. So you fund on the 25th, you have 5 days left. You fund on the 1st, you might have 29 or 30 days left, okay? Depending when you fund. Let's go to impounds here. So for property taxes, you want to make sure you look at your property tax schedule. As you can tell right there, if the loan funds on March, 3 months reserves. If it funds in October, 10 months reserves. So depending on when you're going to fund, it changes your impounds. Taxes are due twice a year, once in November and once in April, okay? So they collect for installment payments, all right? So when you are trying to buy a home and you want to make sure a lender is hustling you or not, some lenders, they'll put 2 months reserves, but if you're funding in the month of October, how can you have 2 months reserves? Sometimes they do that to downplay the taxes, right? Typically, they don't get caught anymore, but some lenders are still trying to weasel and get away with that when they're just trying to bring down their closing costs to get that deal. But that's not right to lie to you about that, right? So if you know, hey, by the way, Mr. or Mrs. Loan Officer or Ms. Loan Officer, right? If you look here, the loan is closing in September. It's 9 months of reserves. Why did you do 4? I know you're short 5 months. Please correct that for me, right? If you do that, I'm sure the lender will back off and do everything by the book at that moment, okay? So if you fund in the month of June, right, it's 6 months. If you fund in the month of October, it's 10 months, okay? So if you have a $600 impound, right, $600, you fund in June, it's $3,600. You fund in October, they're going to collect $6,000 a month in impounds. So if you're trying to figure out when's the best time for you to buy, right, if you close in June, it'll be a lot cheaper than closing in October, all right? So those right there are your impound schedules. The next thing, which is most important, let's finally talk about it. Let's talk about the elephant in the room, lender fees, okay? Let's talk about lender fees. When we're talking about lender fees, right, there's origination. You'll see this on page 2, section A, right? Origination fee, discount fee, underwriting, processing, loan commitment, rate lock, application, or float down, right? If you're buying new construction, there's a float down. So in this lender fee section, right, they might use all these names. But typically, unless you are buying down a specific interest rate, the typical lender fees should be between $1,000 to $1,800. $1,800 is still even on the high side, right? When you see the fees past $1,500 or $1,800, it might be a red alert. Hey, why am I paying above $1,800? Typically, the lender will say because you're buying down the rate to a specific, so you get a specific payment. It's like, I don't want that. I want to see your true rate. I just want to see your lender fees, right? Without origination, without discount, right? And I want to see what the true rate is. At that moment, now you see the true value of what the lender's bringing you for that rate. Once you see the true value, you can decide, hey, should you shop this loan or not, right? A lot of times, lenders are charging these points or these fees to get you a specific rate. They say because you want a specific rate, that's why they're charging you. That's their reason. That's their excuse. Don't buy it, right? First thing you say, give me the lowest par rate without charging me an origination or discount. If you say that, I am sure they're going to be like, but eat, right? Because last thing they want to do is stutter and get caught in a lie. So give me a par rate, right? I just want to see your true lender fees. Should be between $1,000 to $1,800, right? Once you get those fees set, right, then you'll know, right, what each lender's charging you. Okay, so let's talk about this application, right? Sometimes they'll mix the underwriting, processing, and application and loan commitment, right? Those are the ones you're going to see kind of go around, right? Sometimes rate lock, depending on if you're trying to lock a rate for a longer period of time. If you're buying new construction, they might charge you a fee for a rate lock or for a float down. But typically, underwriting, processing, loan commitment, and application should be shuffled in there somewhere. No matter what, it's about $1,000 to $1,800. If you are doing a loan through a mortgage broker, right? The processing fee will be put in page 2, section B in the miscellaneous lender fees, right? Those are non-negotiable because they use a third-party company to process the loan when you broker a loan. So in the miscellaneous, you might see an $800 and $900 charge that you would not normally see, and that is a mortgage broker using a contract processor. Okay, so let's talk about origination and discount. And this is where it's the same thing. They're just trying to come up with different ways to charge it, right? When they charge you an origination, they have to charge it to give you a specific rate, right? To give you that rate for them to make the money they want to make. For example, if a loan officer's comp plan is 2%, I'm just using numbers, right? But you want a specific rate that the lender is only paying them 1%, they would have to charge you 1% origination because they gave you a rate that only paid them 1%. That's why when you're dealing with lenders, right, they can't um, change rates or change compensation depending on who they can sell it to, right? That law changed back in 2013, right? They changed these laws and rules. What they do now is if you have a certain comp plan, right? If you have a certain compensation plan. Let's say my compensation plan is 1 3/4, right? If I sell you that rate, I got my 1 3/4. I always have to sell you a rate that makes me 1 3/4, right? After the par rate and after your adjustments and everything, for that they might have to increase the rate so for you to make your 1 3/4. But if you're like, no, I don't want that rate. If you don't want that rate, that you want a lower rate, then of course they're gonna have to charge you an origination or a discount to give you that rate because their comp plan is set by law. Doesn't matter what program you have, doesn't matter what race you are, doesn't matter where your credit's at. The lender can't make more per person, right? They have to make it on their total volume. So if a lender has a 2-point comp plan, right, their rates will be higher, right? And their rates will be higher and they have to charge you a certain amount, right? That's where most mortgage lenders, right? If you work with a mortgage broker, these brokers, I'm saying there's good things about lenders, there's good things about brokers, right? Don't let these brokers fool you. Okay. So when they tell you they're gonna shop your loan for a better deal, they're gonna shop your loan depending on who they have a comp plan with. If they feel like with this you are willing to pay a specific rate, they'll send their loan to this specific lender that pays that dollar amount. If they know you're shopping around, they have to go with another lender, not to benefit you, just so they can make X amount. They were willing to make less with another lender because they don't want to charge you that origination because they know you're shopping the loan. So when you're working with a mortgage broker, they're not finding you a different lender because typically, unless you're doing some funky product, you're going to FHA, conventional, or VA, right? And all the major lenders all go to sell the 3 loans. United Wholesale, Quicken, Home Point, they all sell the same loans, right? Depending on who the broker has a deal with, right? Hey, this guy is willing to pay this much. I'm going to go with United Wholesale because I want to make my 2.75, right? Oh, this lender, they're only willing to pay 1.5. I have my comp plan 1.5 with Home Point. Let me go with Home Point, right? But if they're like, hey, you need the speed, you have that comp plan of 2.75, right? Sometimes you'll see them have to charge you. You want a specific rate, they have to charge you an origination or discount to give that to you. Or a lot of times you'll see a lender charge you $5,000 in origination, but then discount you a $5,000 lender credit, right? It looks like they're crediting you that origination. They're not. That is the origination they have to charge you. What they're crediting you for that specific rate are your other fees, right? So be careful. I'm not saying that's a bad thing, but people should be upfront, right? Why are you going with another lender? Because I know you're not willing to pay the specific fee that I would go with this lender. That's why I'm going with this other lender. And that's the truth, right? With mortgage banks, right? The lender all the lenders, their loan officer comp plans are set, the guys who work for banks, right? So that's the rate. That is what it is. They might have to do pricing exceptions, but it does not change the loan officer's compensation because by law, they can't change your compensation based on the loan or based on the person. Compensation has to be the same through and through, right? So that's right there are your lender fees. Now we know title fees, we know escrow fees, we know impounds, how to calculate all the impounds. I know I had a little hiccup there earlier. We know miscellaneous fees. So I forgot miscellaneous fees, and now we have lender fees, right? So now we know the 5 fees when we're out there shopping. The fees that the lenders can control are the lender fees that are on page 2, section A of the loan estimate. They can't control title, can't control escrow. Miscellaneous, it all depends on when you're going to fund your loan, right? Depending on the day you're going to fund and the month you're going to fund. That will dictate your miscellaneous. Plus, who you're going to pick, your impounds, right? Who you're going to pick for your hazard insurance, right? So when you're talking to a lender, when you're trying to compare apples to apples, you want to look at the rate, the lender fee, page 2, section A, and then also I forgot to put it on here is section J, the lender credit. If they're giving you a specific rate, are they giving you a lender credit? For example, we had a borrower, we gave them the same rate as another lender, but we were able to give them a lender credit of $3,000 when the other lender didn't charge them, it just gave them at a par rate, right? So now let's figure out what is the cost of these fees. Now that you know the fees, you know what you can shop. What do you look at, right? What's the bill? When the numbers all tally up, this is the answer. If the purchase price is under $350, closing costs, right, is about 3%, 3.5%, right? There's another slide, Andy. 3.5%. If the purchase price is over $350, it's been between 2 to 3%, right? So if you're buying a home, $350, it's under $350, it's about 3 to 3.5%. If you are buying over $350, it's between 3 to 2%, 2.5%, right? So when you're out there looking to purchase a home, just know that you take your total closing costs and you add that up, okay? You add that up. And once you add up, if it goes over that, something's not adding up, right? Especially if you're buying a home, you're doing 3% down conventional or 3.5% down FHA. If the closing cost is more than the down payment, most people go with entry-level buying. If the closing cost is more than the down payment, you're getting charged origination or discount. Then go back to the lender and ask them, hey, what are these fees? Why are these fees? Why am I getting charged to get down this specific rate? Give me a par rate instead, right? So that right there is closing costs. Let's go through it again. If it's under $350, closing costs is between 3.5% to 3%. Over $350, between 3% to 2%, right? The higher you go up on the purchase price, the lower the percentage. Why is that? For example, let's say a lender fee is $1,000, right? The lender fee, right? $1,000. If you buy a house for $200,000, $1,000 is half a point. You buy a home for $600,000, $1,000 is 1/6 of a point. Make sense? So when you're out there, or when you buy $300,000, it's 1/3 of a point. Okay, you buy a house for $400,000, it's 1/4 of a point. So the higher you go up on purchase price, those flat fees, right? They start dwindling away. That's why the percentage drops on higher purchase prices. Also, guys, remember your impounds. If your impounds is $600 a month, if you close in that October month, it's $6,000, right? So definitely be very careful when you're out there, right? You look at what's your down payment. If your closing cost is more, why? But when you go under $350, there is a chance it could be more than the closing down payment. All right, guys. So now that we know what closing costs are, right? I'll give you a little sample of once you know closing costs. When you talk to a lender, you want to make sure you generate this profile, okay? Once you have this profile, you can shop your loan. Once you lender send you a loan estimate, you can identify all the fees, right? You want to generate this profile. You want to know the property type, occupancy, loan type, the goals, right? You want to know down payment percentage, loan amount, interest rate, middle credit score, and purchase price, right? Once you have all that information that one lender gave you, now you can go out and shop with other lenders. All right, guys. So that right there, my friends, are closing costs. Now you know, and you won't get that bill like Kevin Hart, right? Be surprised, right? You'll know these are the 5 categories. What fees can you shop and what fees can't you shop, right? You have the control, but only if you have the knowledge. All right, guys, let's go some Q&A here. Vanessa Rondo, what happens after the home inspection? How long does it take for the release of the home inspection. So when you get a home inspection, typically you want to get it done within 10 days because there's a home inspection contingency, which means you have 10 days to go back and forth with the seller if something is wrong with the house to either drop the purchase price or get a credit, or they're not going to do anything, right? So that's the home inspection. There's a difference between the home inspection and the appraisal. But the home inspection, once they do it, should take about a day or 2 days. My brother was a home inspector. He used to go on his motorcycle, right? He would go to the home, do the home inspection, and within an hour, maybe 2 hours, he would release that home inspection to the seller and the buyer so he can move on to the next one, right? It all depends on their schedule, but typically 24 to 48 hours, right? After the home inspection, then there's appraisal. That's a 14-day contingency. Not 14 days from the home inspection, it's 4 days after the home inspection, all right? So that's the next steps after the home inspection. Hopefully that helps you out. Trish the Fish, new build closing costs, are they usually built into the base price? The answer is yes. Not all, but most of the time. When you're buying new construction, the reason why the lender, the builder lender, is able to credit your closing costs, it's already built into the purchase price. That's why it is rare that a regular lender will beat the builder lender because the builder lender has already built the purchase price, built the closing costs in the purchase price. Hopefully that helps you out. Octavio, after I close, when would be my first mortgage payment? It depends on when your loan funds, but also depends on when the lender draws the note. You want to look at your loan docs. Tell your lender, I want my payments to be 2 months from now or a month from now. Then you have to fund that specific, you have to draw docs at a specific time, then fund at a specific time. But remember, that money's not free. It's interest tacked onto the back of the loan. So when you refinance or sell, you're going to have to pay it off. Hopefully that helps you out. Lorraine Callie, does it take longer to get an offer accepted if we get down payment assistance? No. It's not about down payment assistance. Here is the key secret. Number one, be flexible for the seller to upgrade. Number two, you have to be able to close fast. Number three, if the home doesn't appraise, you can come in with a difference. Those are the most important things to a seller. Hopefully that helps you out. Gus Lucatero, great question. Can I use down payment assistance and use my own cash for closing costs? The answer is yes. Typically, if you're doing down payment assistance, you're going to have to come out of pocket anyways. Typically, out of pocket, depending on when you're going to fund and depending on the down payment assistance program you use, it's going to be between 2 to 2.5% of the purchase price. Mindy Saab, right? With new build, is the deposit you give the builder credit towards your closing costs? It can be. It all depends on how much your closing costs are, and it depends if the seller is covering all your closing costs, then that money will go towards your down payment. If they're not covering all your closing costs, then that money can go towards your closing costs. Hopefully that helps you out. Jesus Mercasio. Hi, Minh. We've been approved for an FHA loan, 3.5% down to $435,000. We have the down payment cash. Anyway, we can speed up the process. This is how you speed up the process. This is how all lenders should behave. Once they collect all your documents, and if they do issue you a pre-approval, they should take your income, your assets, and your credit and send it to their underwriter. Once they send it to the underwriter is going to validate the credit, the income, and the assets, right? And they're going to update the loan application with the information that they validated. Once they do that, they're going to issue something called a underwritten conditional approval. Once they issue that underwritten conditional approval, there's going to be a condition list, which will have credit conditions, income conditions, and asset conditions, right? Once you get those conditions met, then those conditions will clear. Once all your conditions clear, then when you find a house, there's only one type of conditions to clear. The home, which is title, if there's any liens, and then also there's the appraisal, right? Once title and appraisal clears, you're good to go. But if you cleared all your conditions, your credit, your income, and your asset up front before you find a house, butter, slip and slide, boom, it's done. All right, hopefully that helps you out. All right, guys, I want to appreciate everyone who reached through, who liked again. Like I said, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. That Japanese one. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714-332-2526.